Great. We are all started and recording.
Perfect.
We're live. Hey, all right. Well, I guess we'll kick things off. Firstly, I'd like to welcome all of our clients who have joined us for our first webinar of 2026. Our goal of these webinars or these webcasts is to bring timely information and interesting guests on a wide variety of topics. And I know today's call is going to be no different. But before introducing our guest today, I'll remind everyone of a couple of housekeeping items. Firstly, as always, we're recording this webcast. Sometime in the next week, 10 days, we'll be sharing it via email and on our social networks and social media platforms. Little teaser about our expanding social media platforms. Blake has taken the initiative of starting a YouTube channel for the Evolved Wealth Advisors team. So all this content's going to be up, and as well as other content's going to be uploaded to that channel in the coming months. So we'll be sharing more on that with everyone. And then also we've got the chat enabled. So if there's questions that come in, please don't hesitate to type them in the chat. We'll either get to them during this call or endeavor to answer them afterwards. So with that out of the way, I get the pleasure of introducing Dave Szybunka, Senior Portfolio Manager and Managing Director with the energy team at Canoe Financial. Firstly, before introducing Dave, just a bit about Canoe. Most of our clients would be familiar with Canoe. We've partnered with Canoe successfully for a number of years across a number of different mandates. But Canoe are a Calgary headquartered, independently owned, active investment manager overseeing nearly $23 billion in client assets. Their energy team, led by Dave, is here and one of the very few headquartered in Calgary, as they ought to be. Dave's career in the industry started as an analyst with Peters & Co. Those familiar with that Calgary-based energy dealer. He also spent time at Ryan Capital as the head energy portfolio manager before joining Canoe 15 years ago, and now leads their energy portfolio management team across a number of different mandates. He's also the lead PM on Canoe's Alpha Energy Fund, which recently took first place overall in the Canadian Hedge Fund Awards for the best 5 and 10-year return, and second place in 5 and 10-year Sharpe ratios. And but smile on your face, Dave. I'm sure that's an accomplishment you're really proud of, and you should be. I often say that if you're going to listen to a Canadian energy PM talk, there's two guys to listen to, and thankfully Dave's one of them. So Dave, really thankful to have you talking to our clients, and appreciate you taking the time to join us today.
Hey, thanks a lot for having me. Great.
Yeah. So I want to start really broadly and, conversationally, but, based on some of the things that you've communicated with us over the last, half year or year here. Recently, you talked about and suggested that you see that we're sort of 5 years into a 15-year energy cycle. And so maybe you can just kind of lay out that cycle a little bit for us, where we've been, where you think we are now, where we're headed, and why in the energy landscape.
Yeah. I mean, I think it's really important for investors to have context, or an opinion at least, about where they think we are within a cycle, right? These energy cycles take 10 to 15 years to play out. You can really lose sight of that sometimes as you think through the last 18 months and you go through periods of drill baby drill and Trump tariffs and Carney power and OPEC plus adding barrels back and Venezuela headlines. Like, it's easy to get turned upside down. But as long as you kind of have your view of where you are in the cycle, you kind of keep yourself on the right track, right? You're a buyer in dips as you believe where you are, versus a seller into rips as you're at different points in the cycle, right? And so for us, when we look at, like, I lived through how the cycle ends, that 2012 to 2014 period. And I think that's really good context because, like, I was at Canoe. We had, I don't know, 5, 6, 7 funds, 5 sales guys. Nobody knew what a Canoe was. Our energy funds went from $20 million to $800 million in 18 months. And so I'm the smartest guy in the room and I'm trading subsectors and buying services and moving it to infrastructure and all these various subsector calls. But to call it out, you were just in the right place as the cycle was in its blow off move, right? But in that period, like energy's outperforming for multiple years. You see the capital coming in. I've always said to people, what ends a commodity energy cycle is a capital spending cycle where investors embrace the spending. We know that was all getting, but you know what, let's bring the MPV forward and raise equity and accelerate capital spending and. We all lived through that, right? And so no focus on shareholder returns, no focus on kind of balance sheets and maintaining a clean balance sheet. So you kind of saw how the cycle ends, where all the capital's coming in, and I just kind of flipped that back to today. And I'll start you with the title of our fall presentation was Still on Track. Like, I've held hands for 2 years, okay, with all those things I said of drill baby drill in Venezuela and all these various things. So we've watched for 2 years. Investors have more been taking energy weight down. Other sectors have been outperforming. We've done well at Canoe. We've been in the right stocks, subsectors, moving capital around, but energy as a whole has been going sideways for 3 years. Other sectors have outperformed. Money's been leaving. The companies are very focused on shareholder returns. They're not in a capital spending cycle regime. They're spending 40 to 60% of their cash flows running significantly better businesses. There's no equity raises happening all over the place. There's been one in the last 12 months or some version of that. And there's little debt in the cap structures. And so we've been in this digestive phase. And when we go through these bumps around and headlines, I would just say to you, there's just not the ingredients for a multi-year downturn. There's just not. And so that doesn't mean you go up and to the right for 15 years in a row. But when you go through these gyration periods and get a little spooked, they're dips that are meant to be bought given where we think we are.
Great. Thanks again, Dave, for joining us. Today, everyone's talking about AI, and AI does not happen without energy and power. So what do you see how do you see energy playing out for during this 15-year cycle when you include AI into the picture?
I think that's a really important narrative. And let me provide a little bit of context here too. So as I say, kind of where we've been going sideways for 3 years. And remember, there's 3 stages of an energy cycle: disbelief, optimism, euphoria. Those are the 3 phases. So we've been bouncing around this disbelief stage. Commodity prices have been coming down. Inflation's been coming down. Interest rates have been coming down. Fundamentally, a little bit more. OPEC spare capacity has been coming down. Rigs have been coming down. Positioning's been coming down because other sectors have been outperforming. So the starting point today, I feel like, is getting closer to flipping, or we're already in optimism or getting into this blow-off type move. We're very early in that, I think, if we are starting that. But so it always goes doubt, optimism, euphoria. I think we're getting towards optimism because of those things I laid out. But if you, sorry, this kind of broke up here.
Okay, on our side?
Yeah.
It's okay on your side? Okay, yeah, sorry,
Yep,
just
okay
kind
on our
of
side.
screen there. So then if you say, well, what's been happening in the last 30 to 45 days here that's different than the prior 3 years? Like, I've been watching the big bellwether energy companies go up, go down, go up, go down, go up, go out. Like, they've been in these bands for 2 or 3 years. And then you kind of go through the first half of January, and Exxon's breaking out, and Chevron's breaking out, and Schlumberger's breaking out, and Suncor's breaking out, and IMO's breaking out, and these big bellwether energy companies are breaking out. And then I would say in the last kind of part of January into February, it's the relatives that have been happening. These big bellwethers are breaking out relative to the S&P, relative to the TSX. I have not had relative performance for 3 years, since 2022, where energy's been the sector, not other sectors. So now I've teed myself up for your question. What's been happening in the market? Well, we're watching to pick on one area that's very topical on CNBC, if you will, software really get crushed on the back of what's happening with AI, right? You're seeing the pain. People are sniffing out, I know these have been really good businesses. Am I so certain they're going to continue to be good businesses with what's happening in AI? Now let's bring this around to energy. As that's been happening there, these AI companies need a lot of energy. Who is actually not exposed to this whole AI thing and grabbing businesses and really strangling them around the neck of saying, you need to adjust your business because you won't be around if you don't? Energy is actually the opposite on that. AI needs energy. Energy does not need AI. And the market is sniffing out and extending the terminal value within energy. The commodities haven't been ripping, right? The cash flow multiples have actually been expanding. Why? Because the terminal value of energy as a sector is getting expanded in the market's eyes. People are starting to clue in. I think we're going to need a lot of energy. And I don't think, not only is it not going to get disrupted by AI, it is the bottleneck for AI. I think that narrative has been very alive and well in software. It's less talked about on CNBC of what I just said of it's not getting disrupted. It's actually the enabler, if you will, within the market.
Mm-hmm. Mm-hmm. So you're suggesting that it's beyond simply a sector rotation, and it's more structural in terms of it's more structural.
So that's a good question. And so when I just look at the year, energy's outperforming. Now let's just try and talk out why. People came into the year very bearish oil. Mm-hmm. Everyone's talking about a glut.
Just a glut, yeah.
Totally. So when you look at what I look at as an energy manager, I kind of liked the setup because the positioning was very bearish, meaning short positions high, long positions really low. You look at people's portfolios, you have conversations, you go to Peters & Co. conferences, you talk to the generalists, you talk to the hedge funds, and what's the big conclusion coming out the other side? People are very underrepresented in energy in their portfolios. Full stop. So as you play out kind of what's been happening on oil and the oil big boys to start the year, it's been a bit of a chase, right? Is this just getting unwound on that positioning that I just talked about? I think it's probably a combination of what I just said and then what I just said before that. People are cluing in. Energy has been very underinvested in, and we're going to need a lot of it on the back of power and all these various components. And I think these combination of these two things are really important to pay attention to within the market.
Great. One thing you mentioned the big boys, and when you look at most people's energy holdings in their portfolio, it is, a few names. In Canada, Suncor, CNQ, TC Energy, such as. What are these people missing? So what, with your portfolio, what are you adding to those clients of just having those three names or the big names?
Yeah, so when you think about energy cycles, at the start of cycles, you just go up cap because the valuations are too close to each other. And you go through a multi-year downturn from 2014 to 2020, 2021. Risk adjusted, you just go by CNQ and Suncor, right? Risk adjusted. We can all brag about how we bought some energy stock in COVID and made a 10-bagger, but risk adjusted, we should have all just went and bought $10 CNQ. That's it, right? And by the way, they've done a share split or whatever since. And so that's actually like $100 CNQ today. And so as you move through the cycle and the large cap multiples kind of lead that kind of bounce off the lows, when you go through the digestive period that we've been in the last 3 years, at the start of that last 3 years, the multiples are all very close to each other. Some company in Southeast Saskatchewan is trading at a very similar multiple to some oil sands company that has 50 years of reserves. Well, that's wrong. This all gets sorted out in the digestive phase. The market starts to realize, well, some of these assets should trade different than others. That's what's been happening. When you look at how bearish a lot of people have been when I've been marketing on Canada, well, look at Canada relative to the US the last 3 years. We have massively outperformed. It's not even close, okay? Like, it's been oil sands and Montney are a lot longer duration than high declining US shale, some version of that. And those assets are going to be lasting a long time relative to these ones. Shouldn't they have a higher multiple? So this has all been happening, but even within Canada, if that multiple is kind of not close enough, you get, as the cycle matures, Strathcona hostile bidding a meg, if you will. And then the people go, who's next? Athabasca goes on a rip, right? Like, these things slowly take care of themselves over time, and you wake up more the second half of the cycle, and there's a big difference between the multiples of the businesses, right? So this has all been happening the last 2 or 3 years. This is all very healthy. But if you say, why have your funds been outperforming the last couple of years? It's because of our mid-cap exposure. We've been on the right themes. We've been on the Athabascas. We've been on the Clearwaters. We've been on the CS Energy Solutions. Like, we're at the point in the cycle that you can really bolster returns with some of your mid-cap exposure. Now, I think that needs to be balanced, because as you start to get sector rotation like we have on the year, it's actually been very hard for guys like me to keep up to benchmarks on the year because the big bellwethers are breaking out. But if you go on to a multi-year rotation, having some representation down cap is you do want that, right? This is where you still get doubles on some of these intermediates. You get the higher commodity and the higher multiple than you think at the same time, right? Oil goes to $79, $85, and the multiple goes to 10, not 4.5 times $50 oil. That's over, right? That's over. So the puck's going to that latter one, and on that, you're going to have some really good risk-adjusted returns in the mid-caps.
Yeah, it sounds similar to what we're, hoping for at, a broad market level, just a broadening out of, performance beyond just a couple of mega cap names, right? And, if that happens, return patterns become more durable and consistent. And this will be jumping around a little bit, but I wouldn't mind getting back to that AI theme for a minute. I saw recently, lots of charts we see every day, but I saw recently a chart where projected, global power production intersects anticipated energy draw from data centers by the year 2030, which isn't very long from now. 2021 wasn't long, 2022 wasn't long ago. 2030 isn't long from now. So how do you see this playing itself out? Do we see, production expanding? Do we see, alternatives forming a bigger part of the picture? This has to resolve itself, because the lights in our offices aren't going to, they got to stay on if, the AI data centers take up all the energy production capacity.
Yeah, so I mean, you kind of teed it up. Let me just talk about specifically the US. And so, and it's a global comment, but I know the US numbers. And so between now and 2030 in the US, when you look at data center growth planned, 50 gigawatts of power, that's a lot of power. Like, 1 gigawatt powers roughly a 1 million person city, okay? There's 11 cities in the US over 1 million people. And we're going to pop up 50 more cities of 1 million plus people between now and 2030. It ain't happening, man. Like, so there's a bottleneck coming, right? Mm-hmm. And when you think about data centers, just to talk this out, like, you need 99.999% reliability. Well, you don't just flick a switch and get power. Like, what are the sources of energy behind that power? Coal, natural gas, uranium. Those are the 3 areas that give that 99.999% reliability. We can talk about solar and wind and backstop with energy storage, and we own a company called Hydrostore or whatever. But in the grand scheme of things, it's those three main things. As we think through kind of narratives in the market, like the market has clearly got excited about uranium. Again, if you have all the shovels ready to go, approvals, everything, let's go tomorrow. On average, it takes 8 years for a nuclear power facility to get built, right? So we're in 2026. This is going to start inflecting with the backfill in 2034. Like these AI companies need the power yesterday. They're in an arms race. They're trying to lock down the power and the grid. So the bottleneck is here. Natural gas is the main source that is going to supply all this power. And I feel like we are in the infancy. Like one thing that I would just pick up to you is certain areas of this power theme have been doing really well in the market the last 12 months. What hasn't been doing as well? Actually, the power companies, the companies that are the power companies, go pull up Capital Power, go pull up TransAlta, go pull up some of these IPPs in the US. They haven't moved for a year. They're actually, a lot of them are down. Why? Well, I think the market is sniffing out there's a crossroads coming. Big tech versus the lower middle income class. There's a lot of lower middle income class out there. And governments are going to be in a very tough situation. You're already seeing across the US power prices up 40 to 60% in the last 18 to 24 months. And this literally hasn't even started yet. So are you sure the government's not going to step in to literally say these power companies cannot charge over X, or else we're going to run over the lower middle class? Government policy is going to step in here somehow. And any way you slice and dice it, like, you need the gas, you need the power, but who shares in all of this is what's going to be determined. And are the power companies going to be able to get those higher prices? Are you going to see all of a sudden, you're not going to see all of a sudden all these exports of all this gas to Europe and all these other places because they got to bring cheaper power and resource to Americans who are getting run over on their power bills? Any way you slice this, it is not good for these big market capitalization areas of the market, right? Energy is the bottleneck on all of this stuff. And you're creating a backdrop of, should I take care of the everyday Joe, or should I take care of the AI arms race that we're in with China? That ain't an easy answer. But energy is the bottleneck, and it's kind of how I started when I watched these energy stocks breaking out. In the market's eyes, we're kind of starting to ask what you said. Where are we going to get all this power from? That's multiple expanding, because you can feel the growth coming. We're going to need it. As soon as you feel that, that's multiple expanding, right?
And so does that drive a CapEx cycle, do you think?
Well, this is what is interesting to see, because when you actually think about these energy cycles, what ends a commodity cycle is cyclical capital spending tied to that. Where are we seeing that today? Power. Like you're watching, go pull up the services, the US Services Index, the OIH, and go look at all these service companies that are now not just tied to the rig count, they're tacking on all this. I'll give you just-in-time power, and I'm going to build all this power stuff out. That's why Liberty's up so much. That's why Pump's up so much. That's why a bunch of these service companies have turned their business to be all more tied to power. A lot of these, just to try and explain this in layman's terms, there's all these motors that they're building up all this just-in-time power on, supplied by natural gas and stuff. But in the longer term, you can see how larger turbines are the much more efficient way to do that. And all of a sudden you wake up and it's 5 years from now and you don't need all these motors that you just got your first payout on. And now turbines are replacing it all. Like, I'm making up what I'm saying, but you can kind of see how investors are embracing the CapEx tied to power. And just because you start to see signs of that doesn't mean the cycle's over. But that's the start of the end. 5 years from now, as you blow your brains out, and no one's talking to these service companies about what's your return on capital employed. It's just, I don't care, dude. Build it. I need the power yesterday. Just go. And they're paying up for pumps and paying up for all these various pieces. And the big question is, are you sure you're going to get a good return on that? At the start of cycles, sometimes you do. But as this continues, it all deteriorates, right? And so that'll be interesting to watch that play out. Where am I seeing the opposite of that? Back to natural gas and the physical energy tied to all this. We keep saying how we need all the power, but no one wants the gas companies to grow. No one wants gas growth at a time that we're ramping up US LNG exports from 10 to 15. Today we're 20 BCF a day of exports. This is going to 28 BCF a day in the next 18 months. We're just creating a just-in-time system on natural gas, and no one wants the companies to grow. Yeah. Literally, if someone says, I'm going to grow some gas, they get attacked in the market. Just shareholder returns, please. Dividends, buybacks, no growth. So another bottleneck. You guys know this. All the energy commodity cycles end with price spikes, shortages, just-in-time system, governments hoarding commodities to take care of their people, right? It turns into a, I don't care the price, I just need it. That's when that all brews up at a time that the powers of influence are forming and dividing across the globe, which we're all watching, right? That's where the commodity blow-offs tend to happen. So we're still a ways away from that.
Okay. I'm going to ask one more question. We're starting to get some questions from the audience, which we'll ask in just a minute. But I'm going to plug your portfolio, Dave. It's done very well. And when you look at the holdings within it, you have a fairly significant proportion of that in private companies. So can you explain to us why that is important and what's going to happen to that percentage over time, or how you see it playing out?
Yeah, so I mean, the biggest thing for people to understand when they buy our Canoe Energy funds, we're not an oil fund. We're an energy fund. So we look at everything. Like we look at everything tied to all the various subsectors that we invest in. We invested in a company called Abex Technologies here 2 years ago. They're building out a commodities clearinghouse. They might as well be private. They're not that liquid in the public market, but the guys that started ICE and Goldman Sachs guys, Jeff Curry's on the board, like really good pedigree. We're proud of stuff like that. Like that stuff like that has gone from $5.75, where we gave them money 2 years ago, to $45 a share in the digestive phase. Like these are rock star returns that we've been able to have some unique exposure where we're not just buying Baytex and Varen, right? And so that's interesting. But as we bring that over to the privates, we've had some pretty interesting wins there, right? Like when you kind of start early days with Spur Resources, a lot of people know the Clearwater oil play. Spur has the biggest land position there. We were a very early day investor there. We continue to ride that position in our funds. We have stuff like Hydrostore, where I talked about that grid being stabilized. We created a company that is taking the power off the grid during the day, releasing it back to the grid during the night when we all turn on our lights and we need all of that. They're building out this long duration energy storage in Australia, in California. Their now biggest backers are Goldman Sachs and CPP, not little Canoe Financial, as we've handed it off to bigger parties to help fund it. But these are the unique exposures that you get that are on the private side. And I would just kind of also say, at the start of cycles, remember what I said on those large caps, all the multiples are too close. Then as you start going, what's been happening the last kind of 6 months, certain mid-cap multiples are starting to expand. Well, why haven't we put all this money to work in privates the last 2-3 years? Because every dollar's been going into those intermediate publics. And now they're getting the boost. What is going to come in behind that? More private opportunities with the multiple ARB. And we've seen some of that, right? There's a Clearwater company that we've invested in the last 6 months. We're watching the publics go to 8-9 times cash flow as we're buying the privately traded Clearwater Co. that guys are just tired of holding because they've held it for so long at 4 times cash flow. This is a good place to park capital for our investors, right? And so we're watching certain teams get bought out in the last 6 months. And all of a sudden your buddies are starting up the next team again. And there is more access to capital today than the COVID lows. But Canoe Financial is the biggest institutional shareholder of the StartCo. These are the things that over time in the cycle that you get that unique exposure to.
Thank you.
Thanks, Dave. I'm going to ask a question from that came in through the chat from a client, asking a little bit more about the renewables. This is the power generation route that's chosen by the Chinese, and they are in the AI race as well. So what is it that the Chinese are doing differently to harness that, alternative power that, makes it so unreliable here in North America?
China is beyond smart. Like, we should all take a playbook out of what China is doing and just literally copy it. So to kind of provide a bit of background on this, early 2000s, Chinese oil demand is 4 million barrels a day. Fast forward to today, we're 15 million barrels a day, some version of that, 16 million barrels a day. So you're watching places like China. The demand within China is 3 barrels per person per year of oil demand. Well, what are we in North America? 22 barrels per person per year. China does not produce oil. Where does China get their oil? Iran, Saudi, Russia, Venezuela. They're very beholden to these countries in terms of their oil imports. So put yourself in China's shoes. Do you really want to watch 3 barrels per person per year go to 6, 7, 8? Like, your oil demand on the import side is going to go to 40 million barrels a day. Now you're even more beholden to these other countries. So what's been the China plan? The China plan's been really smart. Let's have a long-term approach. Let's have an electrification bias where we can have a lot of electrification and different sources on that energy side and diversify ourselves to provide more power. And so to provide that power, what have they done? They've built a lot of coal facilities. They've built out a lot of renewables. They've built out storage and batteries tied to those renewables. They've built out their LNG terminals to have more storage on LNG and natural gas. They've built out their oil strategic petroleum reserve. Last year, of all the oil inventories that got added globally, 40% of all that oil went to the Chinese strategic petroleum reserve. Super smart, especially as you watch stuff like Venezuela happen, right? So, but they're smart. They've been on this electrification theme saying, I don't want to be more beholden to these other countries for oil imports that are now 27 million barrels a day. So that whole electrification side hasn't just been renewables, it's been we need it all. Coal, renewables, nuclear, SMRs, natural gas, LNG, let's go. Super smart. We should be copying that.
Okay. We're hitting close to our time. We have another question from a client. It says, where does the oil fit in when you talk about natural gas being more expensive, or the oil story is independent of the AI data centers? What is needed for the oil for that on the data center side?
Yeah, and so there is, you got to think about these commodities. Like, a good example would be when Russia invaded Ukraine and then Europe didn't get all of this gas and oil and various components of energy. If one commodity goes up too high, coal goes up too high, then they switch to natural gas, right? Then natural gas goes up too high. All of a sudden, some of these places are using diesel or heating oil or stuff like that. It's like a circular reference, and then the next one goes up, and then the next one goes up, but there's always a switchability. But in the crisis mode of Russia invades Ukraine and you can't get any of it, it's just a circular reference up and to the right. And so when you think about power, the bulk of it's going to be natural gas. But I feel like people miss the point sometimes on just thinking all of this power that we need across everywhere is just data center stuff. No, we have lots of demand across the board. Like, before all this stuff has even been happening, like, global natural gas consumption has been growing at a massive pace. We're using more natural gas at the expense of coal. We're using more natural gas just in our daily lives. Electrification, right? So natural gas is the big side of that, but you do get these pockets of like, when it's very cold in the US over the last couple of weeks, you feel it on the heating oil and distillate side because you start to burn heating oil and distillate, not just natural gas, right? And so I'm trying to give you the answer of like, at different points in time, there is a pull from these other sources of petroleum products, but the big bulk of it is natural gas.
Good. Well, Trent, do you want to close for us?
Sure. I mean, a big thanks, Dave. I think this is a big issue for a lot of countries, and the investment opportunities out there are huge. And as being a son of an oil and gas man, I'm always interested, and I always see it. And when I talk to clients, they're very interested as well. So thanks again for your time. We appreciate it.
Thanks for having me.
I want to thank the clients for joining us as always. Remind them, as Keith kind of brought up earlier, we are expanding our social media presence. So we will be getting in touch with you in regards to that. And then we also will be, we talked about this before, that we're now into 2026 and we're about to hit 5-year anniversary being at Wellington Altus. So there will be something coming very shortly to invite our clients to special events, client events. So watch out for that as well. For me, Keith, and for Dave, I'd like to say thank you and have a great day.
Thanks again, Dave.
Yeah, thanks, guys.
Bye-bye.
Bye now.